Welcome back. New territory for the Federal Reserve. The central bank announcing that through its new emergency lending facility starting today, it will buy corporate bond exchange-traded funds for the first time ever. According to the Wall Street Journal, the Fed sees the ETFs as a fast way to inject money into credit markets as opposed to purchasing bonds directly. Meanwhile, investors bet last week that federal borrowing rates may go negative in the next year, causing two-year treasuries to hit an all-time low on Thursday. Look at that, 0.181% on the two-year, down 0.4 basis points. Former International Monetary Fund chief economist and Harvard University economics and public policy professor Ken Rogoff joins me right now. Ken, it's always a pleasure to see you. Thank you so much for joining us.
Thank you, Maria.
Were you surprised to see the Fed buying these bond ETFs? And I also want to ask you, of course, about this new lending facility and what your expectations are.
Well, obviously, it's a huge development. I mean, I think the first thing to say is the Fed has been holding up the economy, and what the Fed has done has probably had, more impact in sort of holding up firms, holding up markets, even than the $3 trillion in stimulus. They've been heroes. But this is obviously a big step into what we call directed credit. It is wartime finance. It's a really dramatic move. I feel that they felt they had to do it. And I think the question is, well, fine if the economy gets better in a few months, but are we going to sort of slide into sort of a central bank socialism over a longer term, which actually you'll find people in the progressives who want?
John Hilsenroth.
Ken, in addition to what the Fed is doing for the corporate market, we have a U.S. Treasury that's borrowing $3 trillion in just one quarter, the second quarter of this year. You've written a lot in the past about the effects of government debt on the economy. Are you concerned that we're getting to a point where there's so much government debt right now that it's going to hold back growth and the recovery after we get through this virus?
I mean, right now, we're trying to control the free fall, which has a lot bigger effect on the subsequent recovery than whether our debt goes up 3 trillion, 10 trillion, or 15 trillion, frankly. The U.S. has enormous borrowing capacity. The dollar rules the world. That said, it's not a free lunch. There are risks, there are costs. But no, I think we need more stimulus. I don't think this is ending anytime soon. I don't think we're getting any kind of V-shaped recovery. I think it could be 5 years before the U.S. gets back to where it was in 2019. So expect the debt to go up a lot more. I will worry about it when we get there. It is an issue. It's not a free lunch, but there's really not a lot to do.
Yeah, and Peter Navarro was with me on Sunday. He said a similar comment. He says multi-years until we get back to normal. That doesn't mean we're not going to see growth, but getting back to normal and what we looked like in 2019 is going to be a long way off. Real quick, Ken, go ahead. Final comment here.
Well, I would say, following up on the Federal Reserve, I think we are going to need to think about negative interest rates if this lasts. People may complain about it, but it's a market-oriented device. It's not picking winners and losers, and actually deep negative rates, and you actually see the market think this is possible. The Fed has said it wouldn't do it, but if this lasts, it has also said it will do whatever it takes.
All right, we'll leave it there. Ken, good to see you this morning. Thank you, sir. We will watch that for sure.
Thank you.
We're pretty close to negative rates right now. You're talking deep negative. Kenneth Rogoff.